Welcome back to the Emerald Corner. In today's episode, we're going to be talking about LLCs, partnerships, and corporations. How are they taxed and how do you get paid? Well, hey there. I'm Kimberly Ferguson, CEO and founder of Emerald Expectations Accounting. I'm so happy that you're here. The Emerald Corner is a place where life and business meet. So I want to help you have a growing and profitable small business while maintaining a life with your loved ones. Because that's what it's all about, right, people? Today's episode is another episode of Tax Tip Tuesday. So for those of you who don't know what that is where I share with you tips and tricks on how to get ready for tax season, how to save money on your tax return, and answer your specific tax questions. So if you have a specific tax question that you would like me to answer, will you please drop that in the comments below? I would love to make a video just for you. So in honor of the corporate deadline on Friday, we are going to be talking about corporations and partnerships and also LLCs, just because that way we include everything, right? So let's jump in, okay? I'm going to start with an LLC, and that is because an LLC can be any of these things, okay? So an LLC can be a single member LLC, which is taxed like a sole proprietor or a disregarded entity. An LLC can be a partnership when there is more than one member. An LLC could be a C corporation, or an LLC could be an S corporation. Now, those last two require you to make specific elections in order to be taxed as those types of entities, but an LLC can be any one of these. So keep that in mind as we go through, okay? So if you are a single member LLC and no election is made, then you are considered a disregarded entity. So the way that you would pay yourself is by taking a draw or a distribution. And basically what that means is just taking money out of the business account. You have a business account, right? And writing yourself a check to put the money into your personal account, okay? That is called a distribution, a draw, whatever you want to call it. But basically, you are just taking the profits out of the business and giving them to yourself. Now, the way that a single member LLC is taxed is on your personal tax return. You're filing a Schedule C on an individual tax return, and you're being taxed on all of the profits of the business, okay? So then we have a partnership. A partnership could also be a multi-member LLC. So if there's more than one member in your LLC, you are considered a partnership, okay? So a partnership is similar to a single member LLC in the sense that it is considered a pass-through entity. So for a partnership, the income is filed on a Form 1065, which is separate from your individual tax return. However, each of the partners receives what's called a K1, and that is basically their share of the profits from the business, okay? You take the Schedule K1 and you file it with your Form 1040 or your individual tax return, and that is how you pay taxes on that money, okay? All of that profit gets put onto your individual tax return and you pay tax on that profit. Now, how do you get paid in a partnership? As a partner of this entity, you can also receive distributions or draws, similarly to the single member LLC. However, you can also receive what's called a guaranteed payment. This is something that you are doing specific services for the partnership, and therefore you want to make sure that you're getting paid for those services, whether or not the business has profit. That's why it's called guaranteed payment, because you get paid whether or not the business is making money. This is something that is sorted out in a partnership agreement. So if you have a partnership or an LLC that is taxed as a partnership, you need a partnership agreement. If you don't have one, consult with an attorney, please. This partnership agreement is so important to your business. I'll go into it in another video, but basically this is where you're going to map out absolutely everything to do with your partnership. You're going to map out your ownership. You're going to map out your contributions. You're going to map out how you get distributions. If you get guaranteed payments, what happens if one of you dies? What happens if one of you wants to sell your portion of the business, et cetera, et cetera, et cetera. So get that stuff mapped out before it's too late. The next one we have is a corporation. Now, there are two different types of corporations. Most people have heard of the S corporation these days with the TikTok trends, but the other one is actually more popular, but people just don't really know that's what it is, right? So the second option is a C corporation, and that is what a majority of the large corporations in the United States are. They are C corporations. This is the only entity available that is not a pass-through entity. In other words, the entity actually pays the tax, okay? So you file what is called a Form 1120, and in that report, you're going to share your income and your expenses, your shareholders, etc. And then all of the income that you report on that is going to be taxed, okay? And they're taxed at a separate corporate rate, not the same as individuals. Now, how do owners of a corporation get paid? They actually get paid through payroll. So they become W-2 wage earners. They do have an opportunity to receive additional income, but this would come in the form of a dividend. And some of you might be familiar with the term dividend if you have other investments of your own. But basically, the corporation will share some of the profits with the owners via dividends, okay? This is where it gets a little bit more tense, okay? When you receive dividends on your personal income, you have to report those dividends, right? So you're paying taxes on the dividends that you received. The part that causes tension is that the corporation has already paid taxes on that amount as well, because they don't get to deduct dividends. So that is why C corporations often have what's called double taxation when people are discussing that type of entity. So it may not be the most opportune entity for small business owners for this reason, right? And then the last one, the ever popular S corporation, right? So an S corporation is also a pass-through entity, but it also has its own separate tax return. So an S corp, you file a Form 1120S, you report all of your income and expenses on there, and then the owners receive a K1, which is reported on their individual tax return, and that is where they pay the tax, right? Some states have actually created a pass-through entity tax, though. So the partnership and the S corporation may be able to pay taxes on the entity level for those specific states, okay? But keep in mind, you still have to pay federal taxes at the individual level. So is this a benefit? You might want to weigh that with your tax preparer. But how do you get paid as an S corporation? Well, two ways. One is you do have to have a W-2 wage. We've talked about this in previous videos where you have to have a reasonable compensation or a reasonable salary. So you put yourself on payroll for a wage, and then you can also take distributions or draws in addition to your salary. So you have options with an S corporation. If you're not sure which one of these entities you are or which one of these entities is right for you, I highly recommend connecting with a tax strategist. If you don't have a tax strategist, then I would be happy to speak with you about that as well. I'll go ahead and link my details below. If you are considering an S corporation, I highly recommend one of these two videos here. We talk about whether or not S corps are for you, and then we also talk about how in the world this S corp thing actually saves you money. So go ahead and grab one of those videos next. Thank you so much for spending a few minutes of your time with me today. I hope you have a fantastic day, and I will see you in my next video.